Alrighty, let's take a look at some example problems from chapter 26. What this chapter is having us look at is standard costing. And essentially we can think of standard costing as a budget at a unit level. Okay, the overall budget of a company is bigger picture, where you're looking at overall revenues, overall expenses. But what we want to do is kind of drill down a little bit further and determine, or I shouldn't say determine, but compare what we should be spending or what costs we should be incurring to produce a unit of product based on what our budgeted expectations are, and compare that to what our actual costs were to make a product or a unit of inventory. Okay, so to see how this works, let's look at this exercise. Stefani Company has gathered the following information about its product. For direct materials, each unit of production, or excuse me, each unit of product contains 3.10 pounds of materials. The average waste and spoilage per unit produced under normal conditions is 0.3 of a pound. Materials cost $2 per pound, but Stefani always takes the 4% cash discount all of its suppliers offer. Freight costs average 45 cents per pound. We'll come back to the direct labor because what we're going to be doing first for direct materials is we are going to be computing the standard cost per unit. And you think of the standard cost as the budget for material cost per unit produced. So based on normal operating conditions, these are the expectations or the budget per unit for materials. There are two things that make up the cost of direct materials incurred to make each unit. It's going to be the amount we pay for the materials, the cost per pound, as well as the amount of the material that we use. Okay. This particular material is measured in pounds. So to come up with these standard costs, we're going to be looking at two different aspects: the cost and the amount of materials used. Okay, so let's first look at the cost per pound. Okay. Materials cost around $2 per pound, but 4% cash discount is always taken from suppliers when it is offered, and an additional 45 cents per pound is incurred for the freight cost, which means the $2 cost per pound will go down by 4% if I multiply the $2 per pound times 0.04, I come up with an 8-cent discount. So my $2 less the 8-cent discount, $2 minus the 8-cent discount, brings the cost down to $1.92. But then we have to pay 45 cents in freight, bringing the standard cost per pound of material to $2.37. Then each unit of product uses 3.1 pounds of that material. The average waste and spoilage per unit under normal conditions is 0.3 pounds, which means in order to complete a unit, we need 3.1 pounds of materials. In order to get that 3.1 pounds, we will incur waste and spoilage, right? So there's going to be scraps as we're making the unit. So in other words, we need to plan on a standard of 3.4 pounds of materials available to produce each unit. The total standard cost for direct materials is going to be the $2.37 standard cost per pound times the 3.4 standard amount of materials used, for a standard cost of $8.06. In other words, what we're saying is we are budgeting $8.06 in material costs per unit produced. We can do the same thing for labor. Each unit requires 1.3 hours of labor. Setup, cleanup, and downtime average 0.2 hours per unit. The average hourly pay rate of Stefani's employees is $12.50. payroll taxes and fringe benefits, an additional $2.40 per hour. In order to come up with the standard cost of labor for each unit produced, again, we're going to look at two aspects: the cost that we pay per labor hour and the number of hours required per unit. The cost per hour is going to be the $12.50 base hourly pay plus the additional $2.40 in additional benefit costs. The total cost per hour will be $14.90. The number of hours used, 1.3 hours, and an average of an additional 0.2 hours due to downtime. Thus, the total hours used to produce each unit, 1.5 hours. Total cost standard per unit times the standard hours per unit, we come up with a standard of $22.35 per unit. That's the budgeted amount of labor costs per unit. Finally, manufacturing overhead is applied at a rate of $7.20 per direct labor hour. We just figured out that the standard was 1.5 hours per unit. To come up with the standard indirect or overhead cost of producing each unit, we multiply the 1.5 hours, standard labor hours, times the allocation or the application rate of $7.20. Adding up our standard material, standard labor, and standard overhead costs, we calculate a total standard cost per unit of $41.21. Okay, again, this is essentially think of it as a budget per unit. We are budgeting to incur costs of $41.21 for every unit produced. Okay, what we can now do with those standards, once a company establishes those standards as part of the budgeting process, they can calculate variances. Okay? So to look at the variances, and by variances I mean they're going to be comparing standards to actual cost incurred per unit. Okay? So the following direct materials and direct labor data pertain to the operations of this company for the month of August. Here they have given us their actual cost per hour for labor, actual cost per ton of materials used, along with their standards for the hourly labor rate and their standards for the price for the materials. Down here we have the quantities, the actual labor hours used, actual quantity of materials purchased and used, along with the standard hours and the standard amount of materials used. Okay. In order to compute the price and quantity variances for both materials and labor, essentially what we're going to be looking at is formulas. Okay. To calculate the total materials variance. Okay. And when I talk about total variance, a variance can be caused by one of two things. A variance in the material cost in total could be due to the price we paid for the materials, or it could be due to the quantity of the materials that were used to make the inventory. This total materials variance is calculating our total variance, the total variance between the total actual material cost used and what the standard total amount of cost should have been based on the standards. Okay. The total actual amount of material cost is going to be the actual quantity of materials used times the actual price paid for those materials. Okay, going over here to the quantities. Actual quantity of materials used was 1,800 tons. The actual materials price per ton was $2.60. If I multiply the actual quantity used by the actual price, I have calculated the total actual material cost. Okay. To figure out what the variance is, I want to compare the total actual material cost to what the standard or budgeted cost says they should have been. So here I'm going to multiply the standard quantities of materials that should have been used, 1,780 tons, times the standard price that should have been paid, for those materials, 262. If I do the math here, multiply 1,800 times 260, I get the total material actual cost. The standard or the budget amount, comparing the actual cost to what the standards say they should have been, we calculate a variance of $1,640. Now let's take a look at that variance because the actual costs were greater than the standards. In other words, our actual material costs exceeded what the standard says they should have. The total material variance is 1,640, and it is unfavorable. Okay? Why is it unfavorable? Because our actual cost exceeded what the standards or the budget says they should have. Okay? Now that total variance that is unfavorable, we're not sure whether that's due to the fact that we paid more or less for the materials, or if we used more or less. So we're going to break that total material variance down into two parts. We're going to break it down into a materials price variance to figure out how much of that variance is due to price, and we're going to break it down to the quantity to determine how much of that total variance is due to how much we used in the material. Okay. The formulas tell us to calculate the price variance, we are going to multiply the total actual material cost, which is the actual quantity times the actual price, just like we did up here. Total material price variance of 468. We are going to compare that to essentially a flexible budget. We're going to compare that to the actual quantity of materials used at the standard price. Actual quantity of materials used was 1,800, and the standard price was 262. Multiplying the actual quantity times the standard price, I get a total flex budget amount. In other words, what we're saying here is that for the actual quantity of materials used, our standards say we should have paid $471.06. The difference between the actual price and the flexible budget here, $3,600. And that is favorable. Why is that favorable? Because our actual total cost was less than what the flexible budget says it should have been. That is favorable. That's good. We want our costs to be below our budget. You can look and see here in this formula that the only difference between these calculations, one is using the actual price and the other is using the standard price, which is how we kind of isolate the price variance portion. Okay, so part of this total price variance is due to a favorable price variance. Okay, now we can further break down that total variance. In addition to the price, we can calculate the quantity variance. Okay, and what the quantity variance does is it multiplies that flexible budget amount that we calculated and compares it to the total standards. In other words, what we're doing is in this one, we are isolating the actual quantity against the standard quantity because both of these are at the standard price. So this is really the difference between the flex budget and the overall static budget. Okay. So here, looking at our actual quantity times our standard price, actual quantity times our standard price to get our total flex budget. And then we compare that to the standard quantity. Standard quantity is $1,780 times the standard price of $262. Doing that math, I come up with a $5,240 unfavorable variance. Okay, unfavorable because our actual quantity used, the flex budget, was greater than what the standard says it should have been. That is not good. We used more materials than what standards say we should have. It is unfavorable. So look at this total variance for materials up here. We had a total variance of 1640, which was unfavorable. That variance is due to a favorable price variance, but even though we had a favorable price variance, we paid less than what the standards say we should have. It was offset by that unfavorable quantity variance. We used more than we should have. Gave us an overall unfavorable variance for the materials. We can do the same thing for the labor. The only difference is instead of calling it quantity, we're calling it hours because we're measuring our labor in hours. And the rate instead of a price because we pay a rate. But the same thing is going to happen that we did above. The total variance is going to be the difference between the total actual and the total standards. Total labor variance, total actual labor cost, and the total budget standard. Actual hours used of 4,600 at the actual labor rate of $14 per hour. Total labor variance of total actual labor cost is 64.4. We compare that to our total standards. Standard hours should have been 46.40 at a standard rate of 13.50, giving us a total standard cost of 62,640. Total actual cost and total standards gives us an unfavorable variance of 1760. Unfavorable because our actual labor cost exceeded what our standards say they should have. Let's break that total labor variance down into the portion of the variance caused by price paid to labor and the portion of that variance caused by the quantity of labor hours used. Actual hours times the actual rate. Okay, same as what we had up here. Then we multiply by the actual hours at the standard rate. Actual hours again, 4,600, and our standard rate of 13.50. Based on the flex budget, our actual labor cost and our flexible budget, actual hours at the standard rate, we have a $2,300 unfavorable variance. Our actual labor costs were higher than what the flex budget says they should have been for the hours used. Okay, again, here the actual hours were the same. The only thing difference was the actual rate as compared to the standard rate, resulting in a price variance. The portion of this total labor variance due to price is $2,300 unfavorable. Now let's figure out how much the quantity variance is. We are going to use our flex budget again. Actual hours at our standard rate. Flex budget says our labor quantity should be 62.1. The standard hours at the standard rate is our static budget. Standard hours of 46.40 at our standard labor rate of 13.50. Total static budget is 62,640. The difference between those two is $540, and it's favorable. It is favorable because our flex budget amount was less than the static budget. In other words, our actual hours used were less than the standard hours that should have been used based on the overall budget. Okay. So again, that 1760 total unfavorable variance for labor is due to two things. A $2,300 unfavorable variance for price, but that unfavorable price variance was partially offset by a favorable quantity variance. Okay, and that explains the total overall unfavorable variance. Okay, let's use those concepts and try it again, and hopefully this will help it sink in a little bit more. This company produces a single product and has prepared the following standard cost sheet for 1 unit of the product. These are all of their standards for materials and labor. And then during the month of April, the company manufactures 230 units and incurs the actual following cost. So these are all their actual costs. Okay. They want us to go ahead and calculate the materials total variance, materials price variance, materials quantity variance. Okay. Once we have the formulas down, it's really just a matter of dropping in numbers. The total materials variance is the actual quantity at the actual price. Actual quantity of pounds used, 1,900. At the actual price of, well, they didn't give us that, but we can back into it because they gave us the total. If I were to divide my total actual cost of $49.40, which I have here, by the actual pounds purchased and used, I come up with an actual cost of $260. So they had not given us that number, but we were able to back into it. Okay, so total actual cost of $49.40, and multiply out our standards. Our standard quantity is 8 pounds for 230 units. 8 pounds for 230 units. Total standard quantity is 1,840 pounds should have been used to produce that amount of product at a standard price of $2.50 per pound. Total materials variance, $340. It is unfavorable because our actual cost exceeded what the budget says they should have. Now let's break that down into the price variance and the quantity variance for materials. The total price variance is our actual quantity times our actual price. And then we're going to compare that to the flex budget, which is the actual quantity at the standard price. Actual quantity used, 1,900 pounds, at a standard price of $2.50 per pound. Taking the difference between those two, I come up with 190. It is unfavorable. Why is it unfavorable? Because our actual material cost exceeded what the flexible budget says they should have. Now for the quantity, we're going to multiply the actual quantity by the standard price, which is our flex budget, and compare that to the total budget, standard quantity times the standard price. Okay, here is our standard quantity, which remember was the 230 units produced at 8 pounds per unit standard. Okay, so we have the total materials quantity variance of 150, and that is also unfavorable because we actually used more quantity than what our standards say we should have. Total of $150 worth more. So our total materials variance is really a combination of two different variances combined, an unfavorable materials price variance and an unfavorable quantity variance. Okay. Doing the same thing for labor, the total labor variance is going to be the difference between total actual labor costs and the total budget overall, or static budget. Total actual hours used, 700 hours, at the actual rate of, which they didn't give us, our actual. Here is our total actual cost. And if we divide by our total actual hours, we're able to calculate our actual rate of $11.60. Total actual labor cost of $81.20 compared to the budget. We have a standard rate of $12 per hour multiplied by the standard hours allowed for the amount of materials produced. Okay, we have a standard of 3 hours per unit. We produced 230 units. So our standard hours were 690 hours. At a standard rate of 12, the total actual variance overall for labor was 160 favorable. It's favorable because our actual labor costs were less than what the budget says they should have been. Okay. Finally, price variance. We're going to break down the labor variance into the price variance and quantity variance. The labor price variance, total actual hours times the total actual rate, and compare that to the flexible budget, the actual hours at the standard rate. Actual hours were 700. The standard rate is $12 per hour. Difference between the total actual price and the flexible budget price, $280. And that is favorable. It is favorable because the actual costs were less than what was paid for the amount of hours used. The quantity variance is going to be the difference between the flex budget, actual hours at the standard rate, and the total budget, standard hours at the standard rate. The difference between those two is $120. Unfavorable. It is unfavorable because our actual amount of hours used at the standard rate exceeded the standard hours at the standard rate. We used more hours than we should have, so it is unfavorable. Okay. You can see that same problem in more of like what I would just kind of call a diagram format, which you may find easier to visualize. But essentially what this diagram is doing is, let me see if I can make this a little bit smaller and get it all into one page. Maybe too small there. Okay. What this diagram is doing is taking the variances here and putting them into this diagram form such that we see over here is the total actuals, over here is the budget, and in the middle is the flex budget. And so the difference between these two gives us our price variance, and the difference between these two is the quantity variance. And then these two combined gives us the total variance, which is the same as comparing those two columns. Okay, so really all we did was took the formulas from up here and put them into these little columns or boxes, if you want to look at it that way. But it helps us kind of visualize from a diagram format what we're doing with the variances. It accomplishes the same thing as just using the formulas in this format. It really comes down to what do you find easier to view, and how do you find it better or easier to understand. Okay. Okay, the very last problem here is just kind of having you think of using the balanced scorecard to look at company objectives from different perspectives and how to evaluate companies. In accounting, whether it's financial or managerial, we're really focused on the financial aspects, but the Balanced Scorecard reminds us that there are multiple viewpoints from which we need to evaluate companies' success. And so what this is doing is just having you match each of the Balanced Scorecard objectives, which are financial, customer, internal process, learning and growth, to which objective makes more sense. Okay, so if we have an objective to evaluate from the perspective of financial, out of these, the return on assets is going to be the way we would evaluate financial success. How about evaluating success from the customer standpoint? Out of these, we would probably focus on brand recognition. How well is our brand recognized by the customer perspective? Internal process. How effective were we from an internal process viewpoint? How well did we utilize our plant capacity? Okay, that's going to help us evaluate how well our internal processes are working. And finally, learning and growth. How did we do in terms of our learning and growth within the organization? And out of these, the best objective to evaluate is how many employee workdays were missed due to injury. Okay, so just keep in mind that even though we focus on the financial in accounting, there are other ways to evaluate a company's success. And that's what the Balanced Scorecard gets us to keep in mind from a management's perspective.